Of course, this is not financial advice and for entertainment purposes only.
Investors, welcome a very special guest, Mr. Joseph Hogue from Let's Talk Money. Now in this video, we're going to be talking about everything about the illusion and just in general of covered call ETFs. So first off, Joseph, how are you feeling about being on the channel and just about this craze of covered call ETFs and just covered calls being the thing this year in the market?
Great to be here, Marcus. Thanks for having me. And yeah, it has been a really just an amazing transition here from dividend stocks, dividend ETFs, and now into some of these covered call ETFs, the single stock ETFs. I think I saw a report the other day that ETF inflows, fund flows have just broken records year after year. But this year there have been more new single stock and those covered call ETFs than anything else. Tens of billions of dollars going into these, and I think while investors can get dollar signs in their eyes and looking at some of these higher yields, 80, 120% yield dividends on some of these, they can be a little dangerous. And I don't think investors really understand the risks in these.
Now, once again, investors, this is not financial advice and for entertainment purposes only. Do your own research. But the first question for you, Joseph, is what's driving the demand for covered call ETFs and super high income products versus traditional dividend ETFs or dividend stocks, and then even like lower yielding bonds that some people might look at a 2%, 3%, 4% dividend yield, and they throw that out of the window and look at these super high income products with way higher yields.
Sure. Well, I mean, who can resist? Those yields of even some of the lower ones on a JEPI, the JEPQ of 10 and 12%. But then you've got these 20, 40% and even higher income yields. So who can resist that high of a yield? But I think a lot of it is, a lot of these pay out monthly. Some of them even pay out weekly. So it speaks to that dividend or that paycheck replacement idea that much better than some of these quarterly ETFs. Your bills don't get paid every 3 months. So why should your dividends? So a lot of people are attracted to that. I think also, though, it's a convenient option selling strategy all packaged in an ETF. So there's none of these that you can't do yourself. Okay, you can buy the stock, you can sell covered calls against it, maybe even save a little bit of money on that expense ratio in the ETF. But it is so much easier just to have an ETF, do it yourself. That portfolio manager, this is what he does. He tracks that stock and he sells those covered calls on there. He rolls it over. So it's much easier and a little bit more tax efficient at times as well.
Now, from your analyst perspective, what do you think are the pros and cons of covered call ETFs?
Sure. Well, again, you've got that constant dividend stream. It's not necessarily consistent. So I think you really do need to make the distinction between constant and consistent. You might get a dividend every week or every month, but that dividend is going to fluctuate, especially on a lot of these higher ones. Okay, so it's very important to understand what these ETFs are buying. So the underlying or the stock or the basket of stocks that they're buying, as well as that strategy they're using. So a covered call, they are selling call options against these stocks. Now, those call premiums that they collect on those fluctuate up and down with just the market volatility, as well as the ups and downs in these stocks. So more of a market volatility, more crazy roller coaster ride on stocks, those premiums go up, that income goes up, and your portfolio manager or these ETFs, they collect more money. So that's important to understand. That's what's happening and why this income or those dividends are going up and down. That's that's one of the cons there, is that you never quite know where your dividend is going to be, even though it will still probably be fairly high. Again, the pros here, it's done for you. It's a nice ETF package. It is obviously very attractive, some of those higher yields, and is right for a certain type of investor. I think you really need to understand yourself as an investor and what these do and whether it's right for you. And some of these covered calls, some of these ETFs are right for some investors and others are right for others. Some see much higher income, but the share price goes down so much that it does destroy some of that dividend yield. There's others that do a much better job of protecting that share price, protecting your capital, so to speak, and still pay out really good dividends. So something like the JEPI or the JEPQ have done a very good job. Maybe not paying you quite so much in income in those dividends, but they do keep those share prices higher, and so you don't quite lose quite as much of your underlying capital there. One thing you can do if you want to check on these is, of course, just look at the stock price, look at the price chart on the stock and see where that's gone over the past. But also you can go into the historical data tab on Yahoo Finance or really any investing site, and you can see the dividends. If you go in the historical tab there, change for dividends only, you can see the dividends over time, how those have risen and fallen. Or you can go to just the stock price and see how that's risen or fallen adjusted for those dividends. So very important to understand where the dividends have gone and where the price has gone.
Is there a sort of dividend yield that you kind of want to look for as a income investor? Maybe not yourself, but like if you put your mind in like an income investor's shoes, what kind of yield should they be looking for? And what is a yield that is more of a red flag and something that investors should be keeping caution of?
Sure. Yeah. That's a great question because I think, again, if we take it back to different yields for different investors, different strategies for different investors, then we can go investor by investor and say, okay, this is what you want to be looking for. For the long-term buy and hold investor, the investor that just doesn't want to worry about their stocks, is fine with just a stable growing dividend. You're probably going to be looking closer to the range of 3 to maybe 6%, maybe even as high as 8%. You get some of those stocks like Altria, like Philip Morris, that do pay the higher dividend and are fairly stable. That's really going to be the best you're going to do as far as dividend yield. And I know everybody wants to reach for higher yield and get more, but if you just look at their return on capital for the company, if most companies are leveraging their sales growth into maybe a 12% earnings growth, of course they're not going to be able to provide a 15 or 20% dividend off of that stock forever. It's just that's destructive of the of the company and of the business. So long term dividend investors, 3 to 6 or 8%. If you want a little bit higher income, you are able to, you're not worried quite as much about the price or your investment in the stock. You don't want it to go down, but you don't need it to go up quite as much. You just need that income, but you need that income to be safe and stable. Maybe a little bit older investors. Then yeah, you're looking at right around the range of maybe 10 to 15%. I feel like that's more stable and it can be more consistent. And again, you've got names like the JEPI, the JEPQ, which do provide those covered call strategies that can provide that little bit safer and consistent dividends without destroying your investment value. Now, on the other side, if you are okay with the risk, if you're maybe a little bit younger investor that hasn't lost all his hair yet and hasn't seen it gone gray yet, then you can take that risk and you just want the highest income possible. You want to see those dividend checks come in. Then yeah, you can reach for some of those 20, 30, 40% dividend yields. Understand you're going to see the stock price come down. You're going to see that investment come down. So what's really important in those is that you have a replacement percentage of that dividend. So you receive that dividend every week, every month. You take a portion of that and you put it back in the stock, okay? Because a lot of that is actually, return of capital, okay? They are actually giving your money back on that stock rather than just a dividend return on your investment. So you want to take that return of capital, put it back in the stock if you're not going to spend it. That's going to help you keep your investment stable and keep growing those dividends in the future.
All right, guys, imagine this. You have your own business, you opened it up. Congrats. It's super hard. It's super stressful, and you're spending so much time building your own website, building social media posts, creating a domain, and so much more. Well, today's your lucky day because GoDaddy Aero is here to help. GoDaddy Aero helped me create a logo for my passion for ETF investing in what felt like seconds, which was insane, and it's way better than if I did it all for myself for my own business. And with GoDaddy Aero, I needed help to find a domain in what felt like 2 seconds, which was crazy and saved me so much time. GoDaddy Aero also helped me make a social media post, which saved me so much stress and so much time to work on my own business rather than wasting precious time, so I can talk more about ETFs on my channel. Thank you so much to GoDaddy Aero for sponsoring this video. Now you guys can click on the link in the description of this video or on the QR code on your screen to get started today with GoDaddy Aero.
In terms of NAV erosion, we're seeing these cover call products have negative returns on the share price. So you could go on like Google, even like Yahoo Finance, and just see the ticker and then the share price is negative. But if you go on like stockanalysis.com, Seeking Alpha, and you filter for the total return, so the dividends or the distributions plus the share price appreciation, or in this case, it would be depreciation, the returns are actually positive. So my question to you is NAV erosion like something that is a huge red flag? And should investors be really thinking about NAV erosion when they're investing in these covered call products?
It's I would say it's maybe a red flag, but definitely not a deal breaker for a stock. Again, you have to understand what that stock is doing, what that company or ETF is doing, and really, it's kind of built in. It's doing what it's supposed to be doing. Okay, with those higher yields, you're going to get some NAV erosion or destruction, right? So I like that idea of going to some of these sites and looking for the total return. You can do that on Yahoo Finance. If you go to the historical data tab, you go look at the adjusted price column. So that price is going to be adjusted for dividends. So if you do 5 years, you go back, you look at what that adjusted price was 5 years ago, what it is now. That's going to show you, the percent return, the total return over those 5 years. And what we see in some of these is just over the last year. So we've got, outliers, just high flyers like the MSTY, right? The microstrategy tracking high income ETF there by YieldMax actually is about a 9.5 or 10% total return, right? So it is positive. It has produced a 10% total return on your money, as well as, not as well as, but including that very high dividend yield. So again, right in ETFs for the right type of investor. Some people out there just want that income. They don't want to lose money. So those types people in the MSTY would be up 10% over the past year, but would have gotten that income through mostly income. Something like the ULTY, right? The YieldMax ultra high income is actually up 25% total return over the last year. Price plus the dividend.
In terms of diversifications and even investing in these covered call products, do you prefer for investors to look at maybe products that are single stock exposures? So like a MSTY, where the underlying is basically investing in MSTR, or do you think that investors should look into stocks or ETFs in this case that have an index-based approach, like an ULTY, but traditionally it would be like the NASDAQ 100 or the S&P 500, like your JEPI, JEPQ, QQQI, SPYI, etc. So do you prefer index-based cover call ETFs or single stock-based cover call ETFs?
Sure. Well, I got to say, those single stock ETFs scare the hell out of me, really. And maybe it's just because I'm old, right? But I mean, man, they build so much leverage into these sometimes. The MSTY, if you consider Bitcoin as the MSTR, so the strategy stock, as a leveraged bet on Bitcoin, the MSTY is a leveraged bet on leveraged bet. So you can get very high levels of leverage, and of course, it's totally appropriate for someone that has a very bullish outlook on Bitcoin. Okay, if you think Bitcoin is going to continue to go up, MSTR is going to go up, and MSTY is going to really go up. So it can be right for a right type of investor. For myself, a lot of these just have not been tested. Okay, they have not been. Most of these not around since even 2020, but none of them have been around since the 2008 financial crisis. So none of them have been really tested on that stress and liquidity of a stock. Okay, these single stock ETFs, they have to be able to buy those swaps to keep that exposure to the stock, right? So what happens when there just aren't any buyers or any sellers or buyers? No, if any sellers or buyers for that stock, that liquidity just disappears. So they can have some real problems. And I don't think we've seen those tested. And when we eventually do see some kind of a market crash or market volatility, then those will be tested, and there could be some heavy losses on those. So I would. And at that point, when it's a single stock ETF, the argument to just do it yourself becomes much stronger, right? You own the stock, you own those covered calls, you sold those covered calls against it. It becomes much easier just to do it yourself. So I do like the more diversified ones, like the ULTY better. Obviously, the QQQ, right, would be the covered call ETF against the QQQ, and then of course the JEPY and the JEPQ. Just because they're much more diversified, they have been tested, they have been around. You're not going to see that kind of destruction when the market does come down. Now, I would warn people that just because it does own a basket of stocks like the ULTY doesn't necessarily mean it's diversified. A lot of those stocks in that ETF are very much focused on Bitcoin, very much focused on some of the high flying tech stocks. In fact, that fund is put together just by looking at exclusively at volatility. What stocks are the most volatile? What stocks is that portfolio manager going to get the highest premiums in? So, if that market volatility returns, then they are going to see a lot of those stocks come down together. So it's not necessarily the diversification and the safety you might think, or you might get in something like a QYLD, a QDTE even, or the JEPI or the JEPQ.
In terms of dividend frequency, so the traditional approach is quarterly dividend payments, whether it's a dividend stock, dividend ETF, or just regular ETF that has a dividend. Now for these cover call products, it was monthly, and then we have weekly, and now Defiance has an ETF that pays you twice a week. And word on the street is that they might be the first ETF issuer to do daily income payments from cover call products. So my question to you is a dividend frequency something that is important for an income investor in your mind as an analyst?
No, I mean, I'll rephrase that. Of course, and I think we're going to get to a daily one with tokenization of assets, stocks going on chain. With that, we will get to a daily dividend and many daily dividend funds, I'm sure. But as you see the complexity of these ETFs increase, trying to use these swaps and the derivatives and the options to replicate the stock plus get that dividend more frequently, that more that complexity with that going up, the expenses go up, the risks go up, and a lot of times, you don't understand the risks and it works until it doesn't. So I think unless it is very targeted to one of your goals, then you can get a monthly ETF, a monthly dividend ETF, buy 4 of them, not the same one, but buy 4 different monthly ETFs. Look back because typically ETFs even and stocks pay in the same week, the same quarter each year, right? Or the same week of the same month. So you can actually strategize your ETFs or your dividend stocks to pay you weekly or to pay you monthly or, on the specific dates you need. So, again, you go to Yahoo Finance, go to the historical data tab, show dividends only, or pretty much any of these stock investing sites. You can see the exact dates of when these companies have paid out their dividends or when the ETFs have paid out their dividends. So you can actually, kind of plan for when you're going to get those dividends around when your house payment is due, when your car payment is due, and really plan it around your goals, fine tune it for that, rather than just relying on one ETF to pay you every single day or every single week.
Does it scare you when people are thinking about going all in on the cover call ETFs? Now we know there's different yields, there's different risks to each ETF, but when let's say somebody were to go to you and say, hey, I want to go all in these cover call products, does that scare you? Does that make you feel a little bit concerned about them? Or is it more of like, hey, like if that fits your goals and strategies, then go for it?
I get teary-eyed. I get reminiscent, nostalgic, because that's exactly where I was, 20 years. Well, in fact, okay, started in 1999, which was a great time to start investing. Let me tell you, lose all your money the next year. Started in 1999, lost all my money the next year, lost all my money again in 2006 because I'm stupid like that and I don't learn, or 2008, and finally learned in 2010. So believe me, I've made all those mistakes, probably learned more from my mistakes as I ever did as an analyst. So I understand the draw and the attractiveness of 30, 40, 100%, dividend yield. If I could double my money every year, right? But it's speaking from experience, it will come back and bite you. Okay. You never want all of your money in one stock, in one sector, in one theme. For these covered call, for these high yield ETFs, I would say no more than even 20% of your money. And that's probably on the very high side, only for those investors that really need, that income or really like that approach, maybe 20% at the most. Have other themes, have other stocks. And really what you want to do is go to a stock chart, any stock chart that you can overlay the different stock prices, the different stocks and ETFs, and see how they've reacted together. To see, okay, if I buy these 2 ETFs, what am I getting? Am I getting anything that's a little diversified? Okay, because you'll see a lot of these ETFs are pretty much tracking each other along with the market, right? So it doesn't do you much good as far as diversification, as far as safety, to buy 3 or even 4 or 5 ETFs that are pretty much all going to crash at the same time. All right. So you look at those stock charts, see where these stocks have followed each other, and maybe look for something else. Maybe look for some safer dividend stocks, maybe a little bit lower yield. Maybe look for some other sectors in the consumer goods, maybe real estate, stocks, things like that that maybe haven't performed quite as well, but also haven't followed these ETFs quite one for one. So you got a little bit more diversification there, a little bit more safety for when the end comes.
Do you think that cover call ETFs are more for beginner level investors, experienced level investors, or maybe somebody who was younger or older?
Okay. Well, first, I think maybe not necessarily for beginner investors, and that's not trying to be like elitist or anything, but I do really think you need to understand how these ETFs work and the strategy behind them. So, for these covered call ETFs, first you need to know, how an ETF works. Then you need to know how options work. Then you need to know how a covered call ETF works. Okay, so you need to know you need to know how the strategy works, have an outlook on the underlying. Okay, so you need to know, okay, what's this ETF investing in, whether it's tech stocks, whether it's Bitcoin treasury stocks, whether it's high beta volatility stocks. Okay, what's my outlook on those? And then you have to know, okay, what are they doing with that? How are they holding those stocks? What's the strategy? So the call options that they're selling against that, understand that. So that is a lot to understand. All right, and I feel like for a lot of beginner investors, don't try to complicate investing. Okay, I know complicating investing, that's our job here on YouTube, right? We have to sound smart. We have to always have new ideas and new stocks to talk about. That's our job, right? But that is not investing. Okay, investing is about your goals, where you need your money to be. Understand that there is something you need to take what we say as far as stocks and say, okay, is this right for me? Where am I at in my investing journey, my investing experience? And is this very complex covered call swap strategy, leverage on top of Bitcoin leverage, right for what I need right now? Okay, so that's the on the experience side. As far as for the age side, I mean, I'd say it really doesn't matter how old you are. I mean, myself, I'm getting up to where that age where old people are, but I'm not old, so I don't know how I quite feel about that. Um, but it doesn't matter if I'm old or young. It's where I'm at in that investing journey, where my experience is, and what I understand. Because you just need to understand how these work.
Now, last question for you is, what do you think will win, a lower yielding traditional dividend ETF, maybe like a 2 to 5% dividend yield? We got something like SEHD, FDVV, DGRO, VIG, kind of those traditional high quality dividend ETFs, in my opinion, or those ones like right now with 3 to 4 times the yield. I'm not going to even compare the ones that have like 30 more times the yield, but let's go with like a 3% dividend yield with dividend growth. So that's the key, is dividends usually might grow year over year, which is great because you want dividend growth, in my opinion, for an investor who wants income. So do you think that that will win versus the income products that are covered calls, where the income is pretty flat since inception? So you're not having dividend growth, maybe even just limited dividend growth. So what do you think will win long term? Lower yielding with a dividend growth, or higher yielding with little to no dividend growth?
The cop out is it depends on what type of investor you are. What type do you want, that higher income yield? Are you ready to be stressed out a little bit to be able to get it? Or do you want a set it and forget it, low stress kind of dividend growth approach? Okay, for myself, I kind of like to straddle the fence, and hope it doesn't kind of hit, hope it doesn't hurt. But with maybe the JEPI, the JEPQ, because it does have that stability in dividend. It's a little bit higher yield, so I still get a little bit higher yield, but it's not going to destroy my investment, right? That price isn't going down. But of course, this is always in a retirement account, right? So I'm not paying taxes on those dividends. Very important for dividend investors. For someone that wants that set it and forget it approach, then yeah, that 3 to 6% dividend growth is gonna win out. I think those are the long-term companies that you'll never have to worry about, or if you're in a fund, you'll never have to worry about, because there's so many companies in the fund than something like the Dividend Aristocrats Fund, right? There's stocks that have paid dividends for 25 plus years. And sure, year over year, some of those might drop out and some might be added, but over time, it's going to be very high quality names. Okay. For the investors that want the higher income, that are ready for that stress, I say go for it. But again, understand what they're doing, have a positive outlook on what they're doing, the underlying stock or the underlying crypto or whatever they're investing in, and cap it at maybe 10, 15%, 20% at most of your portfolio.
Now, if you guys want to see his YouTube channel, it will be in the link in the description of this video and in the pinned comment section. Once again, thank you so much, Joseph. And if you guys like this video, please give it a like, and I will see you guys for the next one.
Thank you so much for watching. And once again, this is not financial advice. Do your own research. Investing is risky once again. And check out our last video on your screen. I love you guys so much. Crush on the stock market and take it easy. Peace.